almost there. One more day of this, 25 seconds to go until the opening bell this Friday. Equity futures are just about positive, up 1/10%. This move has faded fast going into the opening bell. The Nasdaq 100 is positive by about 1/4%. The Russell up 0.2%. Brutal week. Switch up the board and get to the bond market. Yields just a little bit higher on the session, a little bit higher on the week, by 3 basis points on a 10-year to 322.56. In the FX market, negative 0.6% on euro dollar, breaking 105 again, 104.87. Crude negative 2, down 2%. Energy equities got battered yesterday, 115.19, 115.40 on WTI. Coming into Friday, the S&P down 6% on the week, heading for the biggest weekly drop going back to the pandemic. It's been that bad. I'll get the opening bell in just a moment. I want to get to Abby and get you some movers first. Hey, Abby.
Hey, John. Well, yeah, it's interesting to see this stock action on the morning. Stocks really not holding on to the pre-market gains. Expiration, of course, is today and into a long weekend. As for one stock bucking the bearish trend on this morning and this week, I should say, take a look at Alibaba, up 10.5%. This as China regulators are saying that the IPO can happen. This could be a real inflection point because if you recall back in late 2020, early 2021, when it went the other way, that was the start of China tech going down 70%. Let's watch. We're seeing a little bit of a bounce for Royal Caribbean, up just ever so slightly. Earlier, it had been sharply higher, now flipping negative. This, of course, as the stock down 40% in the month of June alone. True recession fears there. U.S. Steel up 4.7%. Their outlook stronger than expected. And then Wells Fargo holding on to a small gain. This, of course, as yields are flipping higher. It seems anything is possible today, John.
Abby, thank you. About 1 minute and 15 seconds in. I promise you the price action at the opening bell. Here it is. We're positive about 1/3% on the S&P. Materials down 0.2%. Energy down 1/10%. Yesterday was pretty ugly. Real estate top of the pile up 0.6%. Information technology in the mix. We're positive there by about 0.5%. Let's get to the West Coast and catch up with Ed. Morning, Ed.
Yeah, good morning, Jonathan. Happy Friday. We're seeing a relief rally of sorts, right? You look at those mega caps that are gaining at the open, the same stocks that set the Nasdaq 100 to its lowest close since November 2020. Yesterday, we're set for a pretty big weekly drop, third straight week of declines on the Nasdaq 100. I point out Adobe, interesting, one of the laggards, right? Down 4.5% on earnings, revising its full year revenue forecast. Dollar strength. How common a theme has this been among the software names? I like silver linings. This Friday, John, I'll give you one. Valuations have come down, and if you're a tech bull, the debate you're having with yourself is whether yields already reflect higher rates, right? And if valuations have come down, where is the opportunity? Is there an opportunity? Is now the time to buy? But valuations are coming down nonetheless. Also looking at the US-listed shares of Chinese tech companies, in particular names like Alibaba, the PBOC granting Ant Group's application to form a financial holding company, the market using that as a sign that things might be easing off a little bit in the regulatory environment in China, supportive of these Chinese technology companies and those that have financial ambitions as well. Happy Friday.
Happy Friday to you, sir. Can we squeeze in some Twitter? What happened yesterday?
Here we go.
What happened yesterday?
A lot happened. Top line very quickly. Elon Musk did not explicitly commit to the deal. The other top line is he kind of gave his view of what Twitter looks like. He has plans for the platform and he set out his politics, right? I think as Twitter users, we latched onto the idea that extreme views are welcome as long as they fit within the parameters of the law. But sources telling us that a lot of Twitter staff left that meeting feeling divided themselves. You know, he had a lot to say. But the big one, no explicit commitment to the deal, which we thought was what he was going to say.
Did he do the air quotes for extreme views as well? Did he do that?
No, that's me.
That's you.
No, that's me.
Just wanted to make sure. Ed Ludlow on the West Coast. Ed, thank you. Ed talking about some of the pain in big tech. On the Nasdaq year to date, we're down 31%. We've talked about that repeatedly. We caught up with Howard Ward of Gabelli Funds a little bit earlier this morning, who was talking about maybe thinking about backing up the truck and buying some Amazon. Pushed him a little bit, nibbling. He said nibbling, looking at some of these moves, some of these big tech names on sale. His words, not mine. The S&P 500 year to date now down by about 23%. Are we seeing some early signs of capitulation starting to emerge with stocks, heading for their worst week in more than 2 years? Mike Ballard, JP Morgan, expecting any further declines to be limited.
I think we're probably getting sort of closer to the bottom of this bear market than we are the top. That's not to say that equities couldn't still fall further. And I think this recession, if we get one, is going to be a relatively moderate one. At the moment, recession risk is uncomfortably high, but at least the market knows that. So I would stick with neutral on equities.
Taylor Riggs with us now. Hey, Taylor.
John, as the audience knows more than I do, it is time in the market instead of timing the market. And that's sort of the commentary that you're hearing here, that if you have sort of that longer term perspective, if you bought during 2008, if you bought during March of 2020, then it's sort of being able to sort of withstand all of that volatility, and you're still seeing some of that big outperformance. Now, of course, that sometimes is a little bit better for the long-term investors than trying to time in and out of these markets. But as that previous guest mentioned, and some of the big commentary that we're hearing on Bloomberg Markets to Close is also still kind of looking at maybe a 5% drop from here, but we're starting to look at some of the bottoming out a little bit. I think what's interesting is historically during rate increases, stocks are still some of the best inflationary hedges, and that's really what a lot of people are holding on to. Now, that in the past has meant sort of an orderly rise. I think this time around you've seen a lot of volatility. Maybe some shock and awe, maybe 75 basis points instead of 25. But yes, historically, stocks typically, as well, Jeremy Siegel, the professor at Wharton, would say, in the long run are sort of the best outperformers. You mentioned starting to see some signs of a bottoming out. One thing that Gina Martin Adams has been looking at is how we are doing relative to the moving average. Sort of those long-term support lines, you're starting to get some capitulation there, a bottoming out, which is a sign that maybe some investors can come back into the market. Finally, we also have a great viz chart here showing sort of, if you take a look at the inflows, the Qs and the SPYs, if you combine those, you're actually seeing some of the biggest inflows that we've had year to date. So is that a sign that investors are comfortable getting back into these markets? Though I think you saw the redhead yesterday that outflows from bond funds are still seeing some of the worst weekly declines or sort of outflows that they've been seeing in a couple years.
Taylor, longest week ever. Feels that way.
It does.
I've only been here for 3 days of it. Someone said to me yesterday, the longest year ever this week.
Well
Taylor
said.
Riggs, thank you. Wonderful to catch up as always. We've got a little bit of a rally, a bit, up 0.5% on the S&P. BlackRock's Alex Brazier expecting any relief rally to be short-lived.
We are not buying this dip. Because it's not a dip. It's actually driven by a shift in the fundamentals of the equity market. We've got a higher rate path. We've got now a rising probability of recession in the US, a very high likelihood of recession in Europe at the same time. And as a result, equities don't look cheap to us.
We've got an absolutely brilliant panel now. Joining us is Nadia Lovell of UBS, Seema Shah of Principal Global Investors. Nadia, first to you. You've cut your price target. Talk to me about the number and the why.
Yeah, it's been a brutal time in market, but we've reduced our price target for year-end for S&P 500 to 3,900, and a lot of that has to do with our earnings expectation as well as our valuation multiple. Inflation is running hot, the economic data is softening, and we've seen weak retail sales numbers this week, weak housing starts, and we have a Fed that's hiking into all of that. That's usually not a good recipe for any sort of sustainable rally in the equity market, and we also continue to think that consensus expectations are far too high over the next 18 months. So we think the volatility is going to pick up into the upcoming earnings season. This will be maybe the first season you start to see a meaningful reduction in expectations in terms of earnings expectations. So we reduced our earnings expectation for this year and even more so for next year. We just think that markets don't respond well to an earnings downgrade cycle, and that's going to keep a cap on the market. And so we reduced to 3,900 by year end.
Seema, you've been less constructive than most. In fact, at times you've been quite pessimistic about this equity market. Seema, are you on the same page when it comes to earnings revisions? My question has been, where are they?
Yeah, you've got a pretty bearish panel. I'm in complete agreement with Nadia. I think we've seen this very significant leg down in the equity market before you've even started to see earnings start to slow down. Now we are expecting recession. I think the timing is probably your biggest question at this stage. But whenever you do start to see a really rapid turn down in some of the economic data and bring down some of those earnings numbers with it, I think that's when your second meaningful leg starts to get going. So I would say that, between now and the start of the recession, anything can happen. But certainly this is not the end.
So you think risk skewed to the downside. Seema, can you give me an idea of how much downside exists?
Yeah, look, we've been thinking that you can certainly retest a 3,400 level on the S&P 500. So that is a point. Can we go further than that? Well, it depends how deep the recession is going to be, but also it depends on the timing. So let's say that you get a recession towards the end of this year. There's a lot of negativity, but at least it starts to flush out some of the things that we've been seeing. The valuations don't, you've already seen that push down in valuation. So I think you could see maybe a level up at that point. Let's say that the recession doesn't start till end of next year. in which case you've got weakness extending out. You may get a couple of rallies, but unfortunately you have uncertainty weighing on the market. And I think you could actually see a worse case, a worse scenario for equities the longer you wait for recession to come.
That R word, recession, comes up in conversation so much at the moment. Nadia, you say slower growth but no recession. But if I asked you to define what you would call a recession, what would you call a recession? Because we had a negative print already this year. The Atlanta Fed GDP now forecast is at 0. What would you call a recession? And if you expected one, what would it look like?
Yeah, so, we know that typically what a recession is 2 consecutive quarters of negative GDP growth, but you also have to see a spike up in the unemployment rate, and we know that the job market still remain tight. And so even if we might have a couple of quarters of negative GDP growth, a technical recession, we don't see that as a recession. And so we would want to see the labor market pick up in unemployment. And so in near term, we're not calling for a recession. We don't see one over the next 12 months. Of course, our recession probability has increased over the last week, just that we've seen the weaker economic data. But in that sort of environment, if we do end up in a recession, what we're thinking about from our downside scenario for the S&P 500, we think that the S&P could slide through 3,300. That's over 30% down from its prior peak, and that's roughly in line with what you sort of see in an average recession. Of course, as Seema said, there could be a possibility that it overshoots to the downside.
Nadia, I was going through your outlook for the Fed, 75 basis points in July, 50 basis points in September. Then I looked at your call for commodities, $130 Brent. If you see that happen with rates and that happening with crude, my question would be, how on earth do we avoid a downturn in the economy?
The consumer balance sheet still remains strong. Of course, yes, we have seen the saving rate slow to, below pre-pandemic levels. So that does suggest that the consumer is drawing down on some savings. But this consumer across almost every income bracket still have some excess savings, and that should help to provide a cushion and fuel consumption. So as long as the consumer still remains strong, we think that the Fed might be able to avoid a recession.
Constructive on the consumer and the economy, but not on the equity market. Least preferred sectors, consumer discretionary, consumer staples. Why is that, Nadia?
Well, the consumer might go out and spend, but corporation, particularly in the consumer segment, we've already seen some pre-announcements. We've already heard inventory building in these segments of the market. And so that's going to pressure profit margins. And at the end of the day, what the equity market cares about is earnings growth. And so we're pretty concerned about the consumer discretionary area. And also consumer spending is shifting away from goods and towards services.
Seema, I imagine you share that view too.
Yeah, I do. I think what we're seeing though is maybe a little bit more concern on the consumer side. And actually, I think they're very strong today, but there is weakness ahead. And you are beginning to see signs from a lot of the credit card balance data that it's not only kind of the lower wage, but it's also the higher wage people who are starting to become a little bit more cautious with their spending. So I think right now it's strong, but if you fast forward 12 months out, once you've got, as you said, you've got Fed hikes, you've got oil prices higher, you've got food prices higher, there has to be an impact. So yes, consumer discretionary is certainly impacted, but I definitely would call the consumer as the strong point in the economy 12 months from now.
Seema, what's your leading indicator for that kind of thing? What do you look for?
So we've been looking at credit card data. I think that's going to be the number one. And, at these points in time, I think, of course, the hard data is always informative, but it's slow. You need to be looking at more of the survey stuff. So even on the unemployment side, actually, we're looking at the temporary help. That's usually the first thing to go. It's not payrolls. It's job postings and temporary jobs. So those are the kind of things that we need to be looking out for to give us an indication of where we think this US economy is going.
Seema Shah, Nadia Lovell, sticking with us. About 13 minutes into the session, equities just about positive, up 0.8% on the S&P. On the Nasdaq 100, up by 1.4%. Coming up, the blame game in the C-suite, a strengthening US dollar, heading for a third straight week of gains.
We see strong upside in the dollar in the coming month. Global bonds are selling off, the yen is selling off, so the dollar is the final hedge that's left standing. So we do think that there's still a good case to be buying dollars.
Why the dollar ate my profits. Up next.
we see strong upside in the dollar in the coming months. And that's predominantly because we're very bearish for risk assets globally. So the dollar is a place to hide, but it is also benefiting from the fact that none of the other hedges seem to be working right now. Global bonds are selling off, the yen is selling off, so the dollar is the final hedge that's left standing. So we do think that there's still a good case to be buying dollars.
It's part of the big blame game as well. And before I take any credit for the dollar rate my profit, not my line. That line came from my colleagues, Amelia Pollard and Liz Capo-McCormick. You want to read that piece. We have seen a long list of companies now, a growing list of companies, blaming the US dollar for a weaker outlook. Microsoft came out the gates first. The CFO said this: the company expects foreign exchange to decrease total revenue growth by approximately 2 points. Taylor Reese is back with us. And Taylor, I've been surprised others haven't followed.
Yeah, good point. We did hear a little bit of that from Adobe, though, yesterday after the closing bell. And John, we're going to have to go back this weekend and review some of our math. Level 2 currency translation adjustment. The simple math is that when you get big profits overseas in a foreign currency and you want to pull those back into a balance sheet in USD, the stronger the dollars you can see there, the lower the profit. That's sort of the simple idea of this. And you've certainly seen the impact of that given sort of massive dollar strength that really has been the trend in the last few years or so. You mentioned Microsoft, and I think that that was a good one. We've also heard similar from Adobe. And I think, John, the nuance here is that some people have said, well, this is good. At least they're not warning of a slowdown in demand. At least this isn't fundamental. At least it's just a foreign exchange headwind, except that on the bottom line, it all ends up being the same, and it ends up being worse than one would expect, regardless maybe of the cause. But if that's some relief, that maybe could be it, that at least it isn't a huge demand story or a fundamental story. Here, though, is sort of where it all comes together. It's what percent of your sales do you get overseas? Because as I mentioned, you then have to pull all those profits back into a balance sheet based in US dollars. Microsoft, as you mentioned, Adobe, and it is some of the big tech. So as you mentioned at the beginning, we might start hearing a little bit more about this in the months to come.
Taylor Reese, looking forward to it. Looking forward to your coverage later. The close, of course, with the team. Taylor Reese, Romain Bostic and Caroline Hyde a little bit later on this afternoon. Here's the story. For the bulls, the bull case, they look at the equity market hammered this year. For that reason, it's a buy. For the bears, they look at an equity market hammered this year, adjusting to rates and not adjusting to what's set to happen with earnings. Nadia Lovell and Seema Shah very much on the same page on what they think is going to happen with earnings revisions in the coming months. Nadia, I want to come to you and follow up on what Taylor just talked about. How important is this stronger dollar going to be to earnings reports over the next 3 months?
It is important. I mean, our core view here, we're now neutral on the dollar. We removed our most preferred preference about a couple of months ago after the dollar reached a 20-year high. So we do think that the risk to the dollar is more balanced now. But of course, it will be a headwind near term for some companies, particularly on the tech side. We know that overall S&P, about 35% or so of revenues are coming from overseas, but it's a lot more in tech. It's about 60%, and it's even more so in software. So software is probably where you're going to see the most impact from dollar strength.
Seema, your thoughts?
Yeah, again, completely in line. So what we've done recently is we have moved some of the exposure to large cap over to mid cap because so many of these companies in large cap have got that significant revenue exposure outside of the US. Now, not only do we see weaker growth outside the US, but of course you have the double whammy of the stronger dollar. So I think this is really playing into a lot of the positioning details within the equity space. And as I said, one of the reasons why we've moved more into the mid cap.
It's part of a bigger picture of tension that I'm seeing is that energy has persisted higher. I've seen the dollar stronger, and at the same time I've seen the outlook for growth and earnings start to get chipped away at. Now, Nadia, the thing I'm thinking about as I look at energy and the performance of those equities in the S&P 500 yesterday is at what point do we start chipping out those gains again and again and again repeatedly over the next few weeks? We've had a monster move year to date. It's meant to be an anticipatory asset class. A lot of people are coming on and saying growth is going to be bad. The chairman of the Fed is effectively putting a target on the back of oil now by saying it's an important part of inflation expectations. It's ultimately going to be a target. So therefore, as a consequence, Nadia, to some degree, we've got the Fed targeting energy. Do I want to be in energy equities anymore? And is it time to sell that position down after the gain we've had this year?
We don't think so. I mean, you saw a bit of profit taken yesterday. Of course, everything was selling off and so people start to trim some of their winners. But we do still see upside to energy equity, and that has to do with where we think oil prices are going. As you noted earlier, our expectation is for higher for longer. We expect 130 on Brent by September, and we're looking for 125 year-end into the first half of next year. When you just think about it from a supply-demand standpoint, the oil market remains very tight, and there's limited capacity. We're also heading into the travel season. China is reopening. OPEC, yes, they might raise production, but we know that a lot of the OPEC countries have had issues meeting their the existing targets. So we do think that there's still more upside to equity energies, and also we also continue to favor long-dated oil contracts because the futures market is in backwardation.
Nadia Lovell, Seema Shah, to the both of you, great to catch up with you all. To the both of you, thank you. About 23 minutes into this session, your equity market shaping up as follows on the S&P. On the Nasdaq, on the S&P, we're positive 1%. On the Nasdaq, up by 1.7. This note just came out from Bank of America. Our worst fears around the Fed have been confirmed. They fell way behind the curve and are now playing a dangerous game of catch-up. We look for GDP growth to slow to almost zero, inflation to settle at around 3%, and they go on to say, and the Fed to hike rates above 4%. The view from B of A in my inbox just moments ago. Coming up, your trading diary and a sneak peek of next week. From New York, this is Bloomberg. 26 minutes into the session, we're down on the week by 5% now. Biggest week of losses potentially since last week. Looking at a third straight week of losses here. The S&P positive on the session, though, on the day by about 1.1% on the S&P. That's the price action. Here's your trading diary. Look out for the Fed speak. Governor Chris Waller speaking on Saturday. U.S. markets closing on Monday in observance of Juneteenth. St. Louis Fed President Bullard kicking off a busy week of Fed speak with Mester Barkin, Evans, Harker all on the docket. Plus, Chair Powell heads to Capitol Hill for 2 days of testimony starting Wednesday. Finally, some jobless claims on Thursday. And can I squeeze this in? UMich on Friday. University of Michigan sentiment could become a bigger and bigger data point after the chairman referenced that earlier this week in the Fed News Conference. From New York, this was the countdown to the open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Friday, June 17th. Here are the top market stories we're following for you at this hour. Bouncing back, it's been a volatile week for markets. Some green on the screen for stocks as options contracts expire ahead of a long weekend here in the States. Supply chain snarls, they continue in the face of ongoing inflation issues. Grove is going public via SPAC merger. Will the consumer be willing to pay a premium for sustainability? We're going to ask Grove Collaborative CEO Stuart Landesberg and Virgin Group's Richard Branson. One major step, Ukraine taking a major step toward eventual EU membership after winning a recommendation from the bloc's executive body. We're going to dig into all of that in the show. From New York, I'm Kriti Gupta in for Alex Steele with Guy Johnson in London. Welcome to Bloomberg Markets. Guy, I'm exhausted. This week has been exhausting, and yet the stock market still has a lot of action ahead of it. Triple witching, in addition to a long weekend. How do we end today? I'm beyond curious.
I don't know, but I think the witching is going to play a part in what we're about to see. And I think it's been a long and exhausting week. But as you say, I don't think we're done. We're also having to fold some commentary coming through from the Fed into what we're watching here as well, Kriti. We're just getting Esther George out with some comments on the tape indicating her reasoning behind her dissent against that 75 bip raise that we got from the Fed. Remember, she went from 50. She's at the more hawkish end of the spectrum. I viewed that move as adding to policy uncertainty. Simultaneously with the start of the balance sheet runoff, she said, look, that's the line that I think really comes out of this. That I think is the significant takeaway that we're getting from Esther George here. Basically, she is saying that she feels that the 75 basis point move, which in some ways hadn't been flagged. I know it had been flagged in the Journal, but only a few days before the Fed had committed to 50. And as a result of which she just felt that the communication was going to be an issue here. She basically is saying she viewed 75 basis points as adding to policy uncertainty. Now, that's one thing you've got to think about right now. I think Esther George will be back in the pack fairly soon. Where is the pack going, though? Where is the FOMC going? Federal Reserve Chair Jay Powell has just been speaking at a conference about the future of the dollar, reiterating his determination, Kriti, to curb the hottest inflation in 40 years. He's saying that the central bank is committed to and will encourage and continue to encourage the world to transact in dollars. But that's not the kind of key line. But let's take a listen to what he had to say.
The Fed's strong commitment to our price stability mandate contributes to the widespread confidence in the dollar as a store of value. And to that end, my colleagues and I are acutely focused on returning inflation to our 2% objective. Meeting our dual mandate also depends on maintaining financial stability. Our commitment to both the dual mandate and financial stability encourages the international community to hold and use dollars.
I was expecting something a little bit different there. Basically, what he said in that opening set of remarks, Kriti, was that the Fed is committed basically to get inflation back down to target, i.e. back down to 2%. Now, we were talking to Greg Jensen yesterday. I've talked to a lot of people recently, and they're all indicating that they feel the Fed is going to blink, i.e. the Fed is going to accept circa 3% inflation if that is the consequence of avoiding a major recession. If Powell is committed to getting us back down to 2%, that is a really big deal because that implies a much bigger policy shock, Kriti, than maybe the markets are already pricing in.
You know, Guy, I know we're not supposed to say whatever it takes without mentioning Mario Draghi, but it kind of seems like it's that idea, the idea that the Fed is going to do whatever it takes, even if a recession is included, to essentially tackle this inflation. To me, I think a lot of parallels are being made to 1994, to the Greenspan put, but this is a similar narrative that we heard from Volcker, perhaps not to the same extent, but this is the 70s in kind of a mini version repeat.
Absolutely. And that, I think, is where the markets now need to go next. We've had a terrible week. Why have we had a terrible week with asset prices? Well, you've had a series of central banks being led off by the Fed, basically indicated that they are prepared maybe to tolerate a recession if that is the cost for getting inflation under control. The lesser of two evils is a short-term recession rather than the long-term impact that we could have from higher levels of inflation. Stocks clearly have taken a battering. Now, in theory, and you're certainly seeing some evidence for it here today, you would expect stocks to have a bounce, and we are getting just that. The real question is, if Powell is targeting 2% inflation, is any bounce that we're going to see here going to be sustainable? And that is our question of the day. Are stocks due a sustainable bounce? Well, let's bring in Romain Bostick, co-host of Bloomberg Markets, The Close, and Bloomberg Markets reporter Abigail Doolittle. Romain, let's start off with you here. Clearly, stocks have had a terrible week. They never go in a straight line for long. They've gone down and down hard. They are due a bounce. The question here, and I think the operative word in that question, is sustainable.
Well, the short answer is no, and I think that at least if you're going by sort of historical metrics, metrics of valuation here, everything would tell you, at least when looking at the S&P 500 in aggregate, that at 3,700, we haven't quite retraced that valuation level that I guess would sort of meet the definition of what some value investors would look for. The other side of that coin here is where's the support in the market? Traditionally, the support would come from the Fed. The idea that anytime you would have a major sell-off, the Fed, if not by policy measures, at least by communication, would try to provide some reassurance here that would eventually lift the market. But Jay Powell has made clear that he's not really focused on that right now. The Fed isn't really about financial markets anymore. It's really about the economy, and that's what he's focused on.
Abigail, hop into the conversation here because Romain just hit the fundamental side of it, but there's other components of this market. It's not just triple witching day, but you have to look at what is the equity market in particular actually trading on here. Is it margins, is it valuations, or is it simply technicals? Abby, what is the signal here that the equity investor should be following?
Lots of signals at this point, Creedy, and at the end of the day, this all comes down to liquidity. We've had this massive surge in liquidity over the last couple of years, about $9 trillion on the Fed's balance sheet, and now we're dealing with the fact that that's coming out, not just out of the markets, but coming out of the economy. There was a lot of policy stimulus as well, hiking. So, investors really contending with what does it feel like to not have the Fed put. There's a lot of traders that I talk to that it sort of indicate that people who have started trading after 2008, they have no idea what it's like to trade without the Fed. Now we're learning what it's like to not have those training wheels. Relative to the technicals, we're clearly in a bear market. The conversation just a couple of weeks ago was, is this a bear market bounce? Because we have had a couple of more than 10% gains for the S&P 500. Now we know it's a bear market. So how long will this bounce last? Will it be, another 10 or 15% or something along those lines? Will it even turn into that? Right now, volume on the day, 100% above the average. So that has everything to do with options expiration. It does look like we probably are going to see the S&P 500 bounce back up to about 3,300. However, or 4,200, 4,300.
Wow, you scared me there for a second.
Yeah, but longer term, I would say we probably are going to 3,200, maybe even 3,000 if it overshoots.
Okay, let's talk about some of the things that people are focusing on right now. Clearly, we're working our way, and I think it probably accounts for the volume, Abigail. We're working our way through witching, so I think that yes, we can maybe park that to one side.
Yes.
Let's think a little bit about some of the key kind of moving averages. The 200-day moving average has basically since the GFC, has acted as a useful point for the market to bounce off. We're getting close to it. It's around 3,500. Is this time different? I hate to use those words, but those previous occasions where it's bounced off post-GFC is when the Fed has been there with the put and no inflation. The Fed now has inflation. Powell's out. My colleagues and I are acutely focused on returning inflation to our 2% objective. That's the line that he's delivered today, 2%. The Fed, the put, doesn't exist in that kind of environment. So does the 200-day moving average really work in the way that it did?
Well, we're going to find out. I hesitate to say this time is different. It is interesting, though, to note that for the first time in many decades, we're looking at a recessionary environment, potentially, most likely, where the Fed is also going to hike. Now, I will say what was interesting to me about that Wednesday meeting, it was almost as though Fed Chair Jay Powell was trying to have it both ways. Yes, we're going to put on this massive hike, the most in 2 decades, but don't expect that too often, trying to play both sides. At the end of the day, though, we all know that the liquidity is draining out, that they have to deal with this inflationary situation. I think one of the charts, there are two charts that, in addition to the S&P 500 and that moving average that you were talking about, Apple. Let's take a look at Apple on a weekly basis. If it can get back above that 100-week moving average, this bounce could really have something to it. But so long as Apple, the biggest weight to the S&P 500, is below that critical support, and that's one that typically holds, and if it doesn't, then down a bit more, that's a big one to watch. The VIX, it's so interesting to me, the VIX this year really hasn't been participating in the way that it could. The S&P 500 selling off in a big way, but the VIX not taking out its last highs. In fact, yesterday, the S&P 500 carving out its lowest low since December of 2020, but the VIX just at a 33 handle. The last high for the VIX, the S&P 500 was closer to 4,300. So some investors aren't quite as worried. There's some disconnects here to work through. It continues to remind me a lot of the markets between 2000 and 2003, sort of a long, slow, rolling bear market.
A long, slow, rolling bear market. Let's macro this out once again. Romaine, I have to ask about what the playbook is. We had Abigail talk about simply this QE.
Yeah.
Traders don't know how to navigate a
Right.
market without the Federal Reserve. But what happens when we go back into recession, whether it's a short and shallow one or whether
Right.
it's a longer one in the next 10 years? Do we just go back to this kind of QE playbook?
Well, I don't know. I mean, the Fed's pretty much made it clear. I mean, we talk about this idea of quantitative tightening, and I think that's more important, is not only that you sort of have the Fed sort of removed with regards to that boost, whether it's a boost in confidence or an active sort of QE program, but the idea that you have an active quantitative tightening, not just with regards to the policy measures on the rate front, but of course the drawdown on that balance sheet. And I think a lot of people are underestimating the longer term effects of that. Combine this too, just to go back to some of the things that Abigail were talking about, you also have to ask yourself, what are you willing to pay for on a forward basis when it comes to earnings and when it comes to sales?
Yep.
When you look at it on that basis, you're still looking at valuations in aggregate that are still pretty rich here. And if you don't think that the Fed is going to be there, if you don't think that the federal government is going to have enough ammunition from the fiscal policy side or the political will here, are you willing to go 14, 15 years out with regards to earnings and even 3 or 4 years out on a price to sales basis? That is risk, and it's a much higher risk level than what most people had to model over the past, 10 to 12 years.
And then you have to factor in how much are you willing to pay for. We're seeing that issue already in the bond market. Bloomberg's Romaine Bostick and Abigail Doolittle. I mean, we could have this conversation for hours. We thank you both for your time. We're going to continue that exact conversation more on our question of the day, discussing that and more with Steve Sosnick, Interactive Brokers Chief Strategist. That conversation coming up next. This is Bloomberg.
We have a rapidly decelerating economy. I can't recall a time in my career where I can remember economic data and real-time earnings data shifting as quickly as it is now.
Unfortunately, I think there's a fair amount more to go. And you went through last year where asset prices were supported by a tremendous amount of liquidity despite deteriorating fundamentals in terms of the rapid pickup in inflation.
But I am still comfortable saying that we're still in a bubble for value against growth the way we measure it.
Those are some of our guests reacting to this week's sell-off, which brings us back to our question of the day. Are stocks due for a sustainable bounce? Let's ask Steve Sosnick, Interactive Brokers Chief Strategist. He joins me right here on SAG. Steve, thank you as always for joining and for being here in person. It's very exciting. Let's talk about capitulation. Let's talk about this market. I mean, we've seen volatility not just this week, but for, I want to say, 6 months now. We're almost approaching the halfway point of 2022. And it's been a lot more red on the screen than green. What will it take to see that sustainable bounce in the equity market?
I've been asked so many times about capitulation, and I think the problem is because I'm asked about it a lot and because everybody's asking about it, this is not, it's not you. If everybody's asking when do we have capitulation, that's really the same way as asking when can I come in and buy. You really don't get capitulation until everybody loses interest in buying. So it's like this perverse narrative that, you get the capitulation when nobody wants to look for it anymore. Right now, I do see it somewhat in terms of some of the advanced decline numbers, in terms of some of the up volume, down volume numbers, but I'm not seeing it come through in terms of extreme levels of implied volatility, such as the, VIX being one of them. And so we don't have that get me out trade in the options land that we see in the stock land.
Steve, what do you think we've priced so far?
Well, Guy, I think this is the problem. I think we're adjusting to it. I think we finally got through the worst of pricing in the moves upward in bond yields, and that was extraordinarily aggressive. And I think, and the problem is, short-term rates are underlying every pricing model. And so when we were moving up 75 basis points in a week, I think that was wreaking havoc on people's models and on their thinking. And if risk-free assets are impossible to price, how do you price risky assets? I do think it's helpful that we've seen some signs of stabilization in 2-year rates and going out the curve. And I think we're starting to price that in. And if we can get that priced in, if we can see the dollar stop zooming, which we kind of did, if we see crude oil sort of finding its level, then I think we get to price things in a rational manner and really start to find where values lie versus not.
So let's talk about that again, bringing it back to what the market is actually trying to find the signal on, because it kind of seems like if we're talking about a recession, whenever that may be, whether that's in 2023, whether that's 10 years down the road, whatever that might look like, the type of recession is going to determine what the trade actually is. If you start to see a shallow recession, which I think there have been consensus calls for, that we will hit a recession, but it's going to be short, it's going to be sweet, and then we're going to go right back. What is the playbook there?
The playbook is really difficult because ultimately, and I will argue that it's very possible we're actually in a recession right now, right? We had 1 quarter of negative GDP. The Atlanta Fed GDP Now survey says 0 for the coming quarter. We're an eyelash away from the 2 negative prints in a row. So it's very possible we're in that recession.
Well, let me interrupt here. You said that we're in a recession, but if you look at the traditional recession dashboard, unemployment, widespread layoffs, a lack of business investment, those are things that we don't necessarily see. So how do you square the two?
Well, that goes back to your shallow recession point. That's exactly it. So this is very difficult to price in because when you think of recession, you think of all the negatives. If we see 2 negative GDP prints, is that enough? Technically it's a recession, but we're really not in that way yet. Although the question becomes, how do people react in terms of, we see them shutting their wallets, we hear what's going on at Walmart, Target, et cetera. We hear the complaints out there. We all know how much it costs to eat or fill up a car. And I think people have to reckon with this, and these are what the models have to deal with. There isn't really a great paradigm for, we're in this mild recession where some things are doing great, but the GDP numbers are not, the overall stuff, and with inflation really, taking its toll on people. This is very difficult, and that's where the market's having a very difficult time pricing.
Steve, it's Friday before a long weekend. You got an expiry. Any levels that I should be worried about here? Anything I should be thinking about on a single name basis that I should be worrying about here? What are you looking for into the close today?
What I look for, Guy, on a expiration is for the morning. I like to look where the levels are. We managed to skirt, you know, the big put open interests that were below the market this morning. We actually, you know, had a big sigh of relief. Going forward, I'm looking at individual names, individual stocks. I'm looking at, you know, spiders. We're off those levels, but you know, when I last looked, the open interest in the 360 level in spiders was a big one there. Tesla at 600 had big open interest. You know, these are the kind of things that if you get close to these levels, they really can act as a magnet and sometimes as an accelerator into a close, particularly if people really don't want to go home long ahead of a 3-day weekend. It's not clear to me that they do. It's nice to see that people are a bit calmer today than we might have feared.
So very quickly, Steve, have we seen the volatility in the rearview mirror? Do we come back after this long weekend and perhaps see, if we do see a sell-off, maybe a little bit of a lighter sell-off?
I do think that we've seen, it's very hard to maintain the type of volatility we've had, right? We had a correction in the course of a week, you know, so yes, in that sense, and I think that's why you see VIX being relatively modest compared to some of the historical levels, you know, meaning short-term historical levels. Going forward, so I do think it's impossible to say that you know, where it goes. It's quite likely to say that we're not going to sustain these kind of crazy moves going forward. But remember, if we start to bounce, that's volatility too, and volatility counts in both directions. So don't ignore that if we do get that bounce.
Steve, great to see you. Enjoy the long weekends. Hopefully we'll see you again soon. Steve Selznick of Interactive Brokers, thank you very much indeed. Keep an eye on what's happening in the bond market right now, folks. We're seeing quite a sell-off in the 10-year. We're now up 10 basis points. It's really accelerating now. 3.305 is where we're trading. More to follow. This is Bloomberg.
Time for ETF Friday. Eric Balchunas of Bloomberg Intelligence and ETF IQ co-anchor joins us now. Let's tweak our question of the day a little bit. Is any ETF data suggesting a sustained rebound? Eric, what's your take?
Yeah, the good news is that the sort of passive Vanguardian advisor investor is still buying in. Tickers like IBB and VOO, which are retail ETFs used by advisors, are still taking in flows. So the boring vanilla passive investor is buying in. They are not phased. Nothing phases them. I think you need many years of this for them to give up. The bad news is the older boomer investors who are in mutual funds are bailing. Active mutual funds in general have seen $400 billion in outflows this year. And that trumps the $250 billion into ETFs. So you have negative 150 net on that. So the overall retail investor is a seller this year. But on the ETF side, those investors are offering bids. So it's a bit of a mixed bag, but I would say it's a largely negative. And the one area we watch a lot is bond mutual funds, especially from the likes of PIMCO. They've been seeing outflows for 15 straight weeks. If that doesn't stop, I just don't see how you can have a sustained rally, because the bond market influences the stock market. And if these big active bond shops have to keep selling bonds every week because of outflows, it's going to consistently create a sort of suppressing force on the prices of bonds. And if the Fed is so antagonistic towards the bond market, it just seems like a sort of bad 1-2 punch that's going to continue to play off each other for a while.
Eric, a lot of people are looking at divvy ETFs right now, dividend ETFs. Does dividend equal safety because of balance sheet strength?
Yeah, a little bit. High dividend ETFs, which are dividend growers, these are just stocks that have high dividends. They tend to be energy and utilities. So for the last 10 years, nobody wanted these ETFs because you're in bad sectors. But those sectors are doing very well now. So these ETFs are actually holding up. They're about flat this year, but that's way better than the S&P, obviously. And you get the juicy yield, about 3%, about as much as the 10-year. But nobody wants to go into the bond market because of what the Fed's doing. So these ETFs are in that nice zone where you've got the yield, which is attractive for people looking for income, obviously, and then they're holding the right sectors. Again, heavy energy. Anything with energy in it is been like a life raft this year, and so these ETFs have seen 25 billion in flows this year. That's their most ever, and the year's not even half over. So we're watching them. These are ETFs like HDV, VYM, SPYD.
Yeah. It's been interesting to see the volatility around some of these oil stocks starting to increase, and they've had some tough days this week. Eric, always a pleasure. Really enjoyed the show. Thank you very much indeed. Eric Balchunas of Bloomberg Intelligence and ETF IQ. Thank you very much indeed. Of course, you need to tune into that show. More now than ever. It's on Wednesday. It's definitely worth a watch. Coming up, the Bank of Japan resisting the global wave of central bank tightening. We're going to talk to Jeff Yu next about what comes next. How long can they keep this going? This is Bloomberg.
About that all day yesterday. For an hour into the U.S. trading session, Bloomberg's Abigail Doolittle is tracking the moves. Abby, a lot of volatility, and it's only been like an hour of trading.
It's pretty amazing, Kriti, because we in the pre-market had stocks sharply higher. Now we have the S&P 500 down by about 0.25%. So anything is possible. Never a dull day. The Nasdaq, though, managing to hold on to a little bit of a gain here, up about 0.5% as tech outperforms, despite the fact that you have the 10-year yields rising again. So lots of uncertainty on the part of investors. What makes it also interesting that VIX remains down. So the fear index, the uncertainty index, not so fearful or uncertain as has been the case for the year. What we do know, though, is we have another big weekly loss. In fact, we are looking at the 10th weekly loss out of 11, as we can see in the Bloomberg terminal. This is really pretty brutal. If you take a look at these huge weekly losses, this is exactly why we have the S&P 500 in a bear market, down about 23% on the year. All the other indexes there, too. Are we due some sort of a rebound rally as we saw in that early week of June and as we saw at the end of March into April? Let's see whether or not that happens. But the overall trend, as you can see here, is down. One reason to think that maybe that rebound rally is going to come, sort of risk rally. Take a look at the fund flows for QQQ and SPY combined. You can see coming into this week, for the most part down, but now $12.1 billion of inflows coming in. So that's some serious dip buyers, some people really making a bet that, yes, there is going to be some kind of rebound. Maybe it'll be more than a week. Maybe it'll be a little bit more of a sustained bounce within the bear market. We'll have to find out. As for some of the movers on the day, Apple, of course, is a key critical mover, and one reason that you have the indexes basically around even or higher. The biggest weighting there below critical support, that 100-week moving average. Watch Apple to see if it can get it back above that. If that does happen, you could probably see a sustained bounce. Tesla turning higher after that big decline yesterday. Lucid also up 2.2%, and then Moderna up 2.4%. And of course, Guy, both Pfizer and Moderna, their vaccines approved for children in the U.S. above 6 months old.
Absolutely. It's going to be interesting into the close how all of these stocks behave. Keep an eye on Tesla. Some interesting positioning around Tesla into the close today. Abigail, thank you very much indeed. The dollar's jumping a little bit. You've got a shift higher in yields, certainly in the US. You've seen that over the last 10 to 20 minutes. This on a day when we've also seen the Bank of Japan backing off, making a change that other central banks have done, the yen weakening against the dollar after the BOJ maintaining its ultra-easy monetary stance, diverging significantly for now from its global peers. Joining us now, Jeff Hu, BNY Mellon Senior EMEA Market Strategist. Jeff, we're trading $135 yen right now. How high does that number need to be for the BOJ to crack?
Well, so we're talking 140, 145. Let's really pick a number from these levels. So if the yen cracks, then the BOJ will need to crack, and already it's under inflation pressures domestically. It's something that Governor Kuroda had to apologize for. And today, he needs to reconcile his comments. He said that right now it's the type of bad inflation that he is worried about, but more bad inflation will come without any action. He can separate the currency from the monetary policy if he wishes to, but right now, something needs to be done about domestic inflation. This kind of intra-G10 divergence, especially after what happened with the S&B, is unsustainable.
Jeff, in terms of unsustainable, the weakness in the yen, how much longer can it go? Are we inviting currency intervention to some extent? Your take?
Well, it's interesting because a month ago, we're talking about new Plaza Accords and Louvre Accords, and we really pushed back against this idea because that required a lot of coordination, evaluations, adjustment, balance of payments issues. Right now, rather than talk about accords, this has become a single Japan issue. So are there ways in terms of bilateral communication? Start on the verbal, start on the communication side. The US expresses some concern about yen valuations, and then on the Japanese government level, the Ministry of Finance at the end of the day is responsible for Japan's currency as well. When they mention this as well, I think that's the first step, and we could start to hear more and more of these comments.
Jeff, what's the timeline here in terms of the currency move, and B, the BOJ having to react to it? Is it a 3-month story, a 6-month story, a 9-month story? What are we looking at?
Well, I think the next stage post is just going to be Jackson Hole. The Fed is going to maintain its current path. We think that the market has to price in 4% terminal rates higher if necessary, go above that. That's just on a US specific level. But then the carry trade will react, or the yen trade will react, on a dollar yen basis or an aggregate basis. And so we're talking several weeks. Within the quarter, there needs to be a reaction as well, because what we are detecting within our own flows right now, it used to be risk off, you go long dollar yen, but the yen does well against other currencies. But now it's dollar yen goes up, but the yen is being sold against other non-dollar currencies as well. This is new. This has become a yen-specific story, and the BOJ needs to be attuned to this. So people are viewing this in the prism of a yen crisis.
So the prism of a yen crisis, what are the ripple effects here? Because if you're looking at perhaps that yen weakness, well, a lot of it's coming from dollar strength. But in the last, I want to say 48 hours, I've started to hear some calls about cracks coming into this dollar rally. What is the pivot point for the dollar as perhaps, if not the BOJ, but the rest of these G10 central banks perhaps play catch up to the Federal Reserve?
Sure. So two things there. One is once the market prices in a level of terminal rates that the Federal Reserve is going to be comfortable with, then you kind of peak dollar strength. So it's not the dollar cracking, but it's no more dollar strength. So the dollars are turned off all of its boosters, so to speak. But then the next phase is when does the dollar start to weaken? Now that's a separate story. So we've seen what dollar Swiss has done. We've seen what the Swiss franc has done, right? So SMB surprisingly strongly to the hawkish side, but the BOE still not doing as enough as it probably should. The ECB worried about fragmentation, but policy may be a step behind as well too. So now we need the other laggards in the central banking community, especially the ECB and the BOE, and also the BOJ, of course, to really start to push forward. And then on a trade-weighted basis, the dollar begins to come off as well. And finally, of course, you've got China, renminbi. That's an important part of the broader dollar basket. Well, and China's in a different economic situation at this point. But if the Chinese reflation story and the asset story, the equity story, if that's sustainable, more inflows back into China, then that's where maybe some steam can come out off the dollar as well. But that's going to be a more natural process in dollar CNY lower.
Can we just talk a little bit more about the track we're on to the terminal rates for the Fed? There's been this assumption, and I've talked to a lot of people about it recently, that the Fed is going to be comfortable with circa 3% inflation if that is the cost for not having a severe and prolonged recession. We've just had Fed Chair Jay Powell talking about the fact that he is determined to get inflation to 2%, i.e. target. What is the difference, do you think, in the terminal rate the Fed is going to have to achieve for 2% and 3%?
So again, we see that at least the market has to price in 4 or slightly higher. And on that note, we may not get there in the end, but we need maximum pricing on markets' part of higher terminal rates at 4, and then we can have a discussion. And if that means weaker than expected growth, weaker than what the Fed would normally be tolerant of, then so be it, because these are not normal times.
Well, speaking of not normal times, something that is a massive undertaking for the Federal Reserve right now is that quantitative tightening picture. But it looks like it's a almost removal of liquidity at a time when bond market liquidity and stock market liquidity are kind of in question. Is there any chance that the Federal Reserve might actually slow down that QT ramp up?
So that's an important question when it comes to credit spreads, right? So the one area, financial conditions, tightening, which I was a bit more concerned about, is in terms of corporate credit. That when we want to draw comparisons on why the current situation is more benign compared to the global financial crisis, certainly it's in the corporate credit space. But if spreads, if we look at high yields or even investment grade, if things begin to crack there, then maybe the Fed will take a step back. But for the time being, if you look at leverage levels on the household or the corporate side, I don't think they're going to be too concerned about it for the time being. Let's focus on the other aspects of financial conditions, terminal rates, equity markets, and to a lesser extent, the dollar.
Jeff Yu, BNY Mellon Senior Europe, Middle East, and Asia Market Strategist. We thank you. As always, you can throw anything at him, and he'll give you a pretty strong answer. Coming up, Grove Collaborative, maker of sustainable home products, goes public through a SPAC merger with Virgin. We'll speak to Richard Branson, Virgin Group founder, and Stuart Landesberg, Grove Collaborative CEO. That conversation next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. President Biden says he is doing everything he can to bring down inflation. The president spoke to reporters today at a climate change event at the White House.
Using every lever available to me to bring down prices for the American people. And our nations are working together to stabilize global energy markets, including coordinating the largest release from the global global oil reserves in history.
The president added nations should build on the success of the recent global methane pledge. COVID vaccines for children ages 5 and under from Pfizer and Moderna have been given the green light from U.S. regulators. Until now, only Pfizer's vaccine was available for this age group. The Biden administration says the vaccines for the youngest of kids are expected to be rolled out as early as June the 21st. World Wrestling Entertainment says Chief Executive Officer Vince McMahon will step back from his duties whilst the board investigates allegations of misconduct by him and another executive. In a statement, McMahon says he will pledge his full cooperation and that he'll accept the findings and outcome of the investigation. The move comes several days after a Wall Street Journal report described a secret $3 million payment he made to a female former employee with whom he allegedly had an affair. And Ukraine is one step closer to becoming a member of the European Union. Bloomberg has learned the European Commission has recommended Ukraine be granted candidate status with conditions that Kyiv will have to meet in the future on the rule of law, justice and anti-corruption. It is significant for Ukraine, but there's no fast-track path to speed up this arduous membership process, which can normally last more than a decade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy?
Ritika, thank you very much indeed. Grove Collaborative starts trading on the New York Stock Exchange today. The eco-friendly home product maker is going public in a SPAC merger with Virgin Group acquisition. It's a deal valued at $1.5 billion. Joining us now, Stuart Landesberg, co-founder and CEO of Grove Collaborative, and Sir Richard Branson, the Virgin Group founder. Stuart, let me start with you first of all. Since we last spoke, since this deal was announced, the world has changed and changed considerably. Inflation has rocketed. Gas prices have gone through the roof. Financial markets have tumbled. How has the world changed for your business?
So thank you so much for having me. It's a super exciting day for our company. And for us, the world has changed in a lot of ways. But the long-term goal of Grove to change our product category, hand soap, dish soap, bath tissue, to be products that can be a positive force for human and especially environmental health, has not changed. And so we're focused on our long-term mission, and we're really grateful to have a product line that consumers need in every economy. Everybody's still doing their dishes, and we're grateful to be able to bring to consumers sustainable product with extraordinary efficacy and at a really great price point, especially in a time when we know there's a pinch on consumers.
Stuart, let me follow with you there on that. Your brand is based on sustainability. How do you get past that low-hanging fruit of people who already care about the environment and perhaps the people who are saying, well, we don't necessarily want to pay the extra premium for sustainability? How do you attract that demographic?
We've always been about building the biggest tent possible around our sustainability mission. And if you look at our customer base, we are successful not just in the sort of coastal cities, but we do as well in Texas and Idaho and Utah as we do in California and New York. If you look at the targets where we're most successful, half of our top 10 are in metros with fewer than 200,000 people. This is a brand that has always attracted a really wide swath. And if you look at the sources of volume for us, customers who are switching to us, they're switching to us from major brands like Dawn and Clorox. And so we believe that the movement that we're a part of here is in the early stages and is going to define the mass market over the next several years, not be a niche.
Sir Richard, you must be breathing a sigh of relief. Bit of a few moments, I would have thought, in as much as I say, things have certainly changed. When you thought about this SPAC, when you conceived of this SPAC, was this the kind of environment you thought you'd be listing into?
Well, we obviously knew about it over the last sort of 2 or 3 weeks, and very much decided to still go ahead despite the environment. I mean, our belief is that the only future is a sustainable world. The marketplace that we're in, you're going to have downs, you're going to have ups. What matters is that Grove in our opinion, has a fantastic long-term future. And Virgin likes to invest in companies that are sustainable, ideally, that will make a real difference to this world, and that where we do feel that they have a great future ahead, and that have great leadership like with Stu.
Richard, why should investors go the SPAC route? I mean, I'm looking here at our SPAC index on the Bloomberg terminal, and essentially it's doing a round trip. That massive momentum that SPACs and other high beta bids had in early 2021, well, it's essentially disappeared, and it doesn't look to be going anywhere positive at the moment. How do you convince investors that this is the vehicle with which to bring sustainable customers or companies, like Grove Collaborative, to the market through?
I don't think investors should think about investing in SPACs per se. What they should look at is individual companies. I believe that a company like Grove is the kind of company that people should be investing in. I've invested a lot of money in it, despite this turbulent market we're in, and I've invested because I believe that over time, it will do extraordinarily well, and it will make a big difference to this world. So I think investors just have to pick individual companies and ones that they believe in, rather than think, okay, well, let's just put a lot of money into SPACs.
Richard, are you saying that that's it? No more SPACs? Are you done with SPACs? Is this the last one for a while?
No, I didn't say that. I mean, we'd certainly look for SPACs, and if we can find other companies like Grove, we would certainly consider it. I mean, it's interesting when we're going through a turbulent downward spiral at the moment in the marketplace. I've been in business for 50 years. When I started 55 years ago, interest rates were nearly 20%. They were between 18 and 20%. So we were paying 22 to 24%. And you get these cycles, and you just have to accept that every 8 or 9 years you're gonna have a downward cycle. But fortunately, by and large, we have more upward cycles than we do downward cycles. And I think once we're through this turbulent war, I think we're going to see things improving pretty quickly, I believe. But let's hope we can get through this war as soon as possible.
Stuart, let's bring you back into the conversation here. I'm curious about the supply chain issues. You just heard Richard talk about the war, perhaps ending the war. A lot of those ramifications are really continuing to ripple across the world, even as we're 3 months into the war in Ukraine with really no sight and end. What are the ramifications on things like supply chains for your company?
So we strive to build the best possible product, and we look at our markets, about $180 billion in the U.S. alone. And we've built a supply chain that's majority reliant on U.S. suppliers, because we want to be able to deliver the best possible quality at the best price for our consumers. And that doesn't mean we've been immune to supply chain pressure, but we've been able to maintain strong margins by being really focused on innovating with cost in mind, so we can keep prices down for our consumers, and also innovating in a way that allows us to maintain a strong margin while balancing really, really extraordinary quality product for our consumer.
Do you think, though, that the addressable market, Stuart, is now smaller? Consumers are being squeezed. When you're paying $5 at the gas station to fill up the car, and it's costing you a lot of money to do so, that marginal buyer who may have made the switch to your product, does that marginal buyer make that switch, do you think, in this kind of environment?
I think more and more people are getting smart about sustainability every day. I heard recently from one of my...
Stuart, I hear what you're saying, but can they afford to? They want to, but can they afford to?
Well, that's why affordability is so important to our brand. I think there's a stigma that natural products are significantly more expensive and don't work as well as conventionals. And so we really strive to bring innovations to market that aren't just market leading in sustainability and efficacy, but also come in at a low price. Our best-selling hard surface cleaners, for example, are a 1-ounce concentrate that you put into a reusable bottle, and because it's just a 1-ounce concentrate, we not just have a better product than our competitors, but also can come in at a lower price point. So we really want to make make sure that our consumers don't have to sacrifice anything as they turn towards more sustainable products. And that's how we plan to capture the big market. We don't plan to go out as an ultra premium price point. We really want to build a brand that can be a big tent to go and play for the big market share in this huge market.
Richard, I'll give you the final word here. I'm curious about what your next project is. You've spoken very highly of Grove Collaborative. What is your next Grove Collaborative-like effort?
We have a lot going on at the moment. Our cruise company is something which I've got a birthday on Virgin Voyages next month. It's my 70th birthday, being slightly delayed by a couple of years. We just launched it in the Mediterranean and in the Caribbean. It is the most extraordinary cruise company in the world. It's adults only. It's a lot of fun. The feedback from people who go on it is incredible, and that's a company which I think can is a really great flag bearer for Virgin and something we can build into a formidable force. Obviously, things like Virgin Atlantic are doing great guns. I mean, it seems people have shrugged off the recession as far as air travel is concerned, and it's come bouncing back. So there are some good things going on, and of course there are some tough times for a lot of people as well. And obviously with people just having to difficulty paying bills because of high fuel prices, one has to very much feel for them at the moment. But so there's some ups and downs.
Richard Branson, a Virgin Group founder, and Stuart Landsberg, Grove Collaborative CEO, we thank you as always. Such a fascinating conversation as simply we talk about the macroeconomic environment. This is Bloomberg.
That's the story right now. That's what's happening to crude. Brent crude is down by 4.5%. It's rippling into the equity market. Energy stocks are the biggest losing sector here in Europe right now. Stocks have snapped lower over the last hour or so. We're flat on the session now. Carsten Bretsky is going to be joining us from ING next. We'll talk about the ECB. We'll talk about that as well. This is Bloomberg. Friday, the 17th of June, crude is getting crushed, commodities are getting crushed. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So, 30 minutes to the close. Remember Jay Powell drawing a pretty clear line between inflation and oil prices. I think you're continuing to see the ripple effects of that. You've also got what is happening with the dollar story manifesting itself as well. But what it's showing up in is definitely in crude. We're down, like on the global benchmark that is Brent, down by 4.7. TI is having a pretty bad day as well. You're seeing in other commodities as well, into the metals market. That's the epicenter of the action this afternoon. You've seen a bit of a move in bonds as well that's worth paying attention to. Talking of bonds, actually BTPs continue to be bid, but I'm going to draw a line between Brent back into the equity market, which is now unchanged here in Europe at 402 on the Stock 600. The worst performing sector, yes, Kriti, you guessed it, the energy sector.
And of course, we're going to keep an eye on that. Some breaking news crossing the Bloomberg terminal at the moment. Some comments from the Federal Reserve. Commitment to restoring price stability is, quote, unconditional. Really comes back and brings about the question, guys, simply how far is the Fed willing to go? Is recession a deal breaker for going strong to tame inflation? Right now, the consensus seems to be it's not necessarily a deal breaker, but 70%, 80% chance perhaps that they are willing to do whatever it takes. To steal from what Mario Draghi very famously. So let's take a look at the markets here stateside, because the S&P 500 is taking it on the chin, down 0.6%. Nothing in comparison to the 3-4% declines we've seen earlier. If you look at the NASDAQ, the Russell 2000, they are both still in the green, which tells you momentum seems to be the name of the game, at least when it comes to outperformance here. The 10-year yield also not doing a whole lot in the context of that broader volatility. 325 on the 10-year yield, up about 6 basis points. But take a look at this dollar. That's where the story is. The dollar story getting stronger and stronger as you see weakness in the euro, as you see weakness in the Japanese yen, perhaps testing that 23-year high of a 135 handle. And of course, crude, as you pointed out, in the stock market on the European side, one of the worst performers, while on the commodity side, also one of the worst performers. Crude at a 110, down almost 6%. Remember, in the context of volatility, this is the kind of moves we saw during the trade war. Those tariff tweets really speaks to perhaps the growth scare baked into the market right now, Guy.
Kriti, let's go back through those headlines. So there's a few interesting lines in here. This is basically part of the commentary we're getting from the Fed. It's its semi-annual monetary policy report. This report delivered to Congress. Commodity markets temporarily saw stress due to the Ukraine war. Temporarily, I think is a really important word there. Talking about the fact that we are just starting to see some modest easing in job market tightness, and that has now recently appeared. So it's interesting to see that maybe they're talking about some easing in the labour market. They've certainly been focusing on that. But I think coming back to this issue of what is happening in the energy markets and what is happening with inflation, that very tight line that Jay Powell has drawn, I think now being reflected in what we're seeing in crude prices. The Fed kind of kicked things off at the beginning of this week. But remember, on the same day that we had the Fed, Kriti, out with its policy decision, we had that emergency meeting before it, delivered by Christine Lagarde, basically talking about the fact that she wanted to have some sort of emergency procedure, some sort of structure in place that would deal with fragmentation, i.e. containing BTP spreads. She's been talking to finance ministers today, Eurozone finance ministers today, basically starting to lay out some of the kind of ideas around that new anti-crisis tool that will kick in if borrowing costs for weaker nations on the periphery rise too fast. Makes you wonder what kind of job the ECB is now currently in. This is according to people that have been briefed on the discussions and the delivery of those comments to the Eurogroup. Let's talk more about this. Let's talk about the Fed. Let's talk about the ECB. Let's talk about a week that has been incredible, really, in central banking. Carsten Bresky, ING, Germany chief economist, joining us now. Carsten, always great to see you. Your bailiwick, your wheelhouse is the ECB. So let's start there. Is the capital key at the ECB as a guiding force for how monetary policy is delivered now dead?
Well, outdated and clearly put into the drawer, like negative deposit rates will be put into the drawer in a couple of weeks from now. Yes, the capital key is dead again. I think what we heard there this week was that the ECB has become a spread stabilizer, and we all know what is it that you can do in order to stabilize the spread as a central bank. You need to purchase assets, and you cannot do this according to the capital key. If you want to stabilize Italian and German spreads, you will have to buy Italian bonds. Full stop.
Carsten, I have to ask simply about the recession calls that are coming about. It kind of seems like the assumption here was that Europe was going to head into a recession, no questions asked. The U.S., China, they may be able to stay afloat. But now with these more aggressive recession calls in the United States as well, I have to ask, does that magnify the pressure that you're going to see in Europe?
Oh, definitely it will.